Hello everyone and welcome to the channel. My name is Brent and in today's video we're going to go ahead and be comparing three ETFs. I saw this discussion on a Facebook page as far as comparing two S&P 500 funds or ETFs and the total market ETF VTI. So we're going to go ahead and do a comparison with VU, SPY, and VTI. We're going to go ahead and cover four things. One, what is the total return over the same period for these three ETFs? Number two, what is the total amount that we would need to own 100 shares of each of these? Number three, which presents the best opportunity for options for writing calls and puts? And number four, which is probably the best option for the average investor out there? So with that said, if you are brand new to the channel, have not yet subscribed, we cover making money, saving money, and investing money. So definitely go down below, hit the red button to subscribe, make it gray, hit the bell to be notified every time I release a brand new video. And of course, give this video a thumbs up, make it blue, and let's go ahead and get into the video. So we're going to go ahead and jump over and cover number one, what is the total return of the same ETFs over the same period? So we have SPY, VU, and VTI. These are the three ETFs we're going to be taking a look at over the time period, the same time period, but right now we're going to go ahead and cover the maximum time frame that these have been out. And we'll go ahead and punch that here into the screen. We'll kind of zoom in there. So the oldest ETF here is SPY, which originated back in 1994, I believe. That's where the data looks like it's kind of showing from. So this ETF has been around for over 20 some years. Here we are in 2021. So it's at least 26 years old. So this S&P 500 fund just has a ton of, not only history behind it, but it's basically double that of VU, which is another popular one that tracks the S&P 500. VU, which again tracks the S&P 500, wasn't created until middle of 2010, 2011 there, right in that time frame. You can see that they both have very similar performance here over the past few years. And then we have VTI, which originated back around 2001, 2002. And this one here in the blue line has been trending very nicely as well. But this doesn't give you the returns over this time frame. So all three of these ETFs have been around for 10 years. So we're going to go ahead and take a look at this data over the past 10 years. Now, doing a quick run through of their price appreciation and percentage change over this time frame, we can go ahead and look at it over percent change. Now in the top, we have the Vanguard S&P 500 fund up at 229.2%. We have in the purple the SPY fund. This is up 227.6%. And then we have the total stock market ETF up 225%. So overall, it doesn't look too bad there, anywhere from 225 to 229. So really just about a 2 to 4% difference there between the ETFs. Now, if we had invested $10,000 10 years ago today, here we are with the growth of $10,000. So we put $10,000 in and we left it sitting there, what would have appreciated to? So each of these funds here, these ETFs, they're up at 32,000 with the highest, with the VU up at 32,920 and VTI with 32,570. So not a big difference there, but this is only looking at the price change overall. Now each of these ETFs pays out dividends. So what we actually want to showcase here is the total return level of these ETFs. So going ahead and bringing it back over to the normalized percent change. So we're right in that 225 to 229% change, and that is just with the price appreciation. If we bring in the total return level of these ETFs, we can see here that the total return of Vanguard's fund, the VU, is up 304.6%. So that's a much bigger number versus 229. So that's nearly 70% difference there to the upside. In second place, we have SPY at 302%, and we have VTI at 297%. So a big difference there with dividends being paid out and being reinvested. So this is just DRIP, the dividend reinvestment program. So if you buy any one of these ETFs, turn on DRIP and just let it drip over time, you're looking at nearly a 70% or almost double what the price appreciation and ETF appreciation would be over that time frame of 10 years. So we're only going to be looking at the total return level here going forward, and we'll also look at percent difference. So here, remember we saw that it was at 34%, 34,000 here. So if we look at the difference here, so 32,000. So there's nearly an $8,000 difference there with dividends being reinvested versus not being reinvested there. So we've basically taken a look at the total return of these funds, or again, ETFs over the same time frame. So the reason that VU outperforms SPY is because of the expense ratio, which we'll cover here in just a second. Here we can see that this is only beating at about roughly $260, but that's that expense ratio over the past 10 years. So if you're investing in the long term, it may not seem, too much of a difference. I noticed that a lot of investors do choose VU over SPY. I'm one of them. I've mainly invested in VU and really haven't looked at SPY up until I've done this video. I kind of did, my own research prior to making this video. And one of the reasons I wanted to make this video out there, just so others can see the differences between these three ETFs and why you may want to invest in one over the other. So now that we've covered the total return over the same period, let's go in number 2. What is the total amount needed that we would need in order to own 100 shares of each of these ETFs? So here, let's go ahead and look at the price and just look at it as a normal format here. And here we have SPY valued at $431.38. So that is a big difference between VTI down here at $222.38. So that's nearly double the price right there. So let's go ahead and use my little spreadsheet here. So VU, in order to own 100 shares, VU is currently priced at $396.54. So $396.54. It would roughly cost $39,654 at today's prices. SPY is $431.38, so $431.38. That one would come in at $43,138 to own 100 shares. And we have VTI here at $222.38, so $222.38. So VTI, in order to own 100 shares, you would only need $22,238. So that's nearly half of, VU and SPY. So big difference there between these three funds as far as if you're trying to accumulate 100 shares. Now that we've covered how much it would cost to buy 100 shares of each of these ETFs, let's go ahead and just take a look at their option opportunity. We're not going to be focused on the dollar points of each of these ETFs as far as what you can get for the calls and puts, but just the opportunity. How often do they have options available? So we're going to go ahead and start off by taking a look at VTI. This is one that I am holding over on my Merrill Edge portfolio. So we click on research here, and we can go ahead and click on the option chain, and this will bring up the options for this ETF. Now, VTI just had options expire on Friday. I'm pretty excited. I wrote a call and a put. Both of them closed out of the money. So on my call option, I didn't have to sell my VTI at $225 because it pulled back. I was able to keep, I believe, $50 or $60 of my premium. And then I had wrote a put for $215. It never fell down to $215, so I didn't have to buy those 100 shares at $215. So I got to keep my premium there of anywhere from $30 to $40. So there alone, I made about $80 to $100 on that call and put option. And my unit cost for VTI is right around $220. So buying at $215, 100 shares would actually lower my cost basis. So that was actually a pretty good, opportunity there. Now here we can see that VTI has options every single month: 16 July, 20 August, 17 September, and so on. So VTI has options every single month. With 100 shares, again, as we talked about VTI, you could buy 100 shares with $22,000. So you could start buying up 100 shares. Here, we're looking at August. We're looking at the current price. We could rewrite a covered calls for 225 strike price. Maybe the market will kind of fluctuate within that time frame. Someone bid it for 230, so we could probably do 230 and get it executed really quickly. We make $230, so it's $2.30 per share, and there's 100 shares within an option. So it's $2.30 times 100, so it's just $230 in a premium that you would just get paid directly into your account. So we could actually write this. These happen every single month, so this is just like a nice dividend that you're getting paid out on a monthly basis. $230 here, nice and easy. If you think the market is going to go down or up, this could be profitable either way. You'll make money on the premium as you get it. If it goes up to 225, you'll make money on the way up until 225, and then you'll sell those positions. You'll collect the capital appreciation. You'll collect your premium. If it doesn't hit 225, it'll fall out of the money. Your shares won't be assigned. You'll keep your 100 shares. You'll keep your premium, and you'll walk away to write another covered call. And so that takes place every single month. So let's go ahead and move on to the next one. This is VU. Actually, I could have done it right down here. I'm going to go ahead and move right there, punch it in there, go ahead and click that. Now VU will appear here in just a second. Now VU, again, has options every single month. The 16th of July ones just had expired. If we're looking at $3.96 right now, that's the current share price. $400 is the next one. We can see that there's a big difference right here. So I'm actually going to go ahead and record this. So VTI, I'm going to go ahead and just kind of put it down. What is our opportunity? So the next one up, we're going to go ahead and just use this next one up here as an example. So we're going to go ahead and go 222.39 is the current price. 225 is the next one up. That is a difference of 1.17%. So I'm going to go ahead and record it here. A 225 is a strike. And that would be a 1.17% difference. So 1.17%. That's how much it would need to change to hit the strike price. And we would collect $249 in premium if we just sold that right now. So we'll go ahead and go like that. Yeah, this is just for information along the way to see the opportunity that each of these ETFs would present. So okay, we just kind of wrote that down, and now we're going to go ahead and move over to VOO, VOO, type in there. So we're looking for a 20 August, current share price is $3.96. So we're going to go ahead and bust out my handy dandy calculator. So $3.96, our difference we're looking for is 1.17. So plus 1.17%. So $401. Let's go over to Merrill. Let's see if there's a 401. The closest one there would be 400. So we're going to go ahead and say 400 would be the covered call that we'd be able to write. We would collect $478 in premium for 478. 478. Oh no, that goes right here. It would be a $400 strike price. So $400, and that actually ended up being, actually we didn't do the math there. So 396 and 400. So for that to happen, the price would only need to move roughly 0.85%. 0.85%. And we would collect $478 by selling this. So this is nearly double. Let's see here, 478 divided by 2, that's $239 right there. But again, it takes you nearly double. Not as much, here we have, it takes us 22,000 to own 100 shares. Here it takes us 39, so not quite double, but you get double the premium for selling the same option within the same time frame. But you can see that the risk here is a little bit more. So with almost the same amount invested, with 200 shares of VTI, you could write 2 covered calls for 225, and you would get that 249 times 2 and that would be $498 with a slightly higher, percent different there for VTI. Now, the last one we're looking at is SPY. Now, I haven't ever looked at SPY in the past. This is what kind of made me look into and creating this video. Was that SPY? I kind of skipped over the option chain there. I just had to punch in their number. But if we look at the option chain here for SPY, we'll go ahead and see that SPY is currently priced. Let's go ahead and look at August. Oh, okay. Right off the bat, opportunity for options right here. The options for 16 July just expired or closed, we were signed or whatever. The next available ones are for 19 July. After that, 21 July. So here we can see that these options happen, 19 is next Monday. The 21st is Wednesday. There's probably going to be a 23rd right there. So these options are taking place every few days. It's looking like every Monday, Wednesday, and Friday. There's options. So every single week, you could write calls and puts on them for a Monday, for a Wednesday, for a Friday. This opportunity has has a higher chance. So the next time here, for 21 July, the current price here is at $431. Let's go ahead and see what is the next price it would be with a 1.17%. 436. Okay, let me go ahead and just verify. 1.17. Whoops. So we add that and we go 1.17%. So we're looking for the same risk level. So $436, we're looking for a strike of that, 436. So here's a strike right here, 436. That would only net us 0.41 cents or 100 shares. That's $41 of premium or a strike price of 436. But again, this is for 21 July. So this is for Monday. So by the time we went all the way to August 20th, on these other options, we're collecting $478 and $249 here for these calls. But SPY, if we write this call for 436, that's the same, that's a 1.17% difference within just 3 days. The market would need to move 1.17%, and you would collect $41. You write these here for the 26th and the 23rd. So again, the market here, it doesn't quite make it to 436. It gets to 434, 435, doesn't get assigned. You keep your shares. You write the next covered call for 23 July. Next time you add another 2% to it, it goes up to 437. Here you collect another $45, another $45, and so on. So over the time frame, in that month time frame, that VTI or VU would have had just one opportunity for options. Here you would have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So if each of these, if you adjust your covered position, so 14 times, and you made a minimum of say $40 on each one that you wrote, that's $560 that you would collect in premium. And that's overshooting it by quite a bit there with the current price. Writing your covered calls, 2% or so higher. Sometimes you might get those options assigned out, but you're going to be collecting premium along the way. And if those options do get assigned out, you're shooting higher with your strike price. So those options that get assigned out, you're going to be selling out of them at capital appreciation. You're going to be making money with capital appreciation. You're going to be making money on your strike price. And right now we're trading near all-time highs. So the market, it will pull back eventually below wherever you're selling them off at with your strike. And then you'll just rebuy 100 shares with your cost base, the money that was deposited back towards you, plus all the premium that you've collected along the way when that does occur. So I thought that this was kind of interesting. I may actually end up selling my VTI positions and just buying, 100 shares of SPY or, something like that along the lines. Right now I own a little over 200 and some shares of VTI. I'm only able to write two options on them. But maybe I could buy some SPY, start writing some calls and puts more often. At least calls. I'm not going to mess with puts because I don't have the capital to be investing into SPY in more than just one or two, options. So I thought that was interesting. Let me know down in the comment section below. Do you guys own VTI, VU, or SPY? Did you guys know that SPY has options every 2-3 days? Let me know down in the comment section below. I thought that was really interesting. I don't know of any other stocks or ETFs out there that offer options 3 times a week. If you do know of any, let me know down in the comment section below. All the options that I'm currently invested in are any month-by-month time frame. So if we went out and just looked at it a month from now for 20 August, let's see what the options would be in here. So at 436 right here, that would be $468. Let's see here, 468. So that actually comes out underneath. Let's see, what was that one again? 249 times 2. D8 times 2. Whoops. That would be 498. Okay, so yeah, SPY, if you did month out covered calls, you would actually get less premium. But again, if you're writing covered calls, once or twice a week, let's say we cut that 14 down to say 10. Maybe you only write 10 calls within that time frame, and you're collecting $40 along the way. I guess if you're not writing as many covered calls in that same time frame, it doesn't perform as well as VTI and VU. But here with SPY, you're able to collect roughly $40 with very little risk because of how much of a spread you can actually have on a week-by-week basis. So here we're looking at 21 July. We don't have to shoot really low. We can shoot for 436. If the share price doesn't climb to 436, that's a $5 difference there, then I will keep that $41 of premium and I'll be able to write myself another covered call for 23 July. If the stock price is going down, I can write, just kind of have more options this way. So I think SPY does present more options as far as investing. But if I were a brand new investor trying to accumulate shares in order to write options, I think VTI would be the best bet. So let me know down in the comment section below, what is your preference when it comes to ETFs, writing options with ETFs, or do you write options mainly on single stocks? So that is going to be it for this video. Let me know down in the comment section below if you have any comments or questions. Again, if you are brand new to the channel, have not yet subscribed, go down below, hit the red button to subscribe, make it gray, hit the bell to be notified every time I release a brand new video, and of course, give this video a thumbs up, make it blue. We cover making money, saving money, and investing money. And thank you all for tuning in. Remember to hit the thumbs up, and I will see you guys in the next video. Bye-bye.